All right, let's get right into Chapter 1, Business Understanding. So, interactive brokers. At its core, it's this highly automated global electronic broker.
Think massive digital infrastructure for worldwide trading.
Exactly. They provide direct access trading, clearing services across tons of financial products. And their client base is really international.
The key is their tech, though. They've built it themselves over, what, 4 decades?
Over 4 decades, yeah. And that gives them massive efficiencies, lower costs.
It's not like they just bolted on some software. They were tech first from day one.
Right. Build that way, it lets them automate so much.
Which means lower operational costs for them and better prices for customers. Critical. So if you're in the U.S., you've basically got 2 main choices, IBKR Pro and IBKR Lite.
Right. Pro is for the more, let's say, sophisticated active traders.
Tiered commissions, so volume helps. Advanced platforms like Trader Workstation.
Which can look pretty intimidating at first glance, like a cockpit.
Totally.
Yeah.
But they push for bust execution with their smart routing. Plus, their margin rates are really competitive.
Very competitive. Then there's IBKR Lite. That's aimed more at the retail crowd, people trading less often.
The big draw there is commission-free trading on U.S. stocks and ETFs.
Which they offer through payment for order flow or PFOF. They get a small payment for routing your order.
Simpler interface, too. Easier for beginners, maybe.
Definitely simpler. But the trade-off is the interest on your cash and the margin rates aren't quite as good as Pro.
Makes sense. Depends on your trading style. So how does this all translate into revenue for IBKR?
Several streams. The biggest is net interest income.
Right. Q1 2025, that was $770 million, up 3% year over year.
And that comes mainly from interest on margin loans clients take out.
And investing the cash customers hold in their accounts.
But remember, they also pay interest to clients on cash, so that offsets it a bit.
And this whole stream is pretty sensitive to interest rate changes, right?
Very sensitive. Rising rates have been a tailwind recently. Falling rates could be a headwind. Definitely something to watch.
Okay. Second big piece, commissions.
And here they saw really strong growth. Q1 2025 hit $514 million.
Wow. Up 36% year over year. That's substantial.
It is. It's the fees on client trades fixed or tiered for Pro users.
And 0 for light users on U.S. stocks ETFs. That big jump clearly means way more trading activity.
Absolutely. Shows a direct link between market activity and their performance. When markets are busy, they benefit.
Then you have other fees and services. That was $78 million in Q1, also up nicely, 32%.
This is kind of a catch-all, right? Fees for risky portfolios, the PFOF from Lite, market data subscriptions.
Yeah, various bits and pieces.
Yeah.
And finally, other income. This one's more variable.
$65 million in Q1, way up year over year. A big part of that is their currency diversification strategy, holding capital in different currencies. They call it global.
So gains or losses depending on currency movements. Adds a bit of volatility.
Definitely less predictable than the core interest and commission revenues.
Now, the sheer range of what you can trade, it's huge. Stocks, options, futures, Forex, bonds, funds, ETFs.
Crypto, CFDs, even prediction markets.
It's incredible. And the global access single account gets you into over 160 markets, 36 countries, 28 currencies.
That's a massive differentiator. Not many platforms offer that kind of breadth.
Plus multiple platforms, TWS, mobile, web APIs for developers.
And tons of tools. 90-plus order types, research from hundreds of providers, portfolio analysis, margin lending.
Stock yield enhancement program too, lend to shares for income, services for financial advisors. It's comprehensive.
That combo of product breadth and global reach is really their unique selling point, especially for sophisticated traders.
And size-wise. As of end Q1 2025, largest U.S. electronic platform by darts.
3.62 million client accounts, up 32%.
$573.5 billion in client equity, up 23%.
3.52 million darts daily, that's trades per day, up 50%.
And get this, 83% of their customers are outside the U.S.
That's huge. Really underscores their global footprint. $158 billion in total assets. They're a major global player.
So value proposition boils down to low cost, global access, wide product range, powerful tech.
Especially appealing for sophisticated investors, active traders, institutions. Low margin rates, interest on cash, efficient execution via smart routing.
They're built around providing serious value, if you know how to use it.
And those dual revenue streams, interest and commissions are key. Diversified, but with different sensitivities.
Right, and the pro-light strategy makes sense for targeting different markets, but adds complexity too.
Definitely a balancing act.
Okay, let's shift gears. Chapter 2, Management Evaluation. Who's steering the ship?
At the top, Thomas Peterfy, founder, chairman, a real pioneer in electronic trading.
Founded Timber Hill back in '77, then IBKR in 93. Amazing track record of innovation.
And critically, he still owns 74.2% of the company. That aligns his interests massively with shareholders.
It's a very powerful signal, yeah. Then there's Milan Galik, the CEO and president.
He's been there since 1990. Started as a software developer, Peter Spy recruited him.
Played a key role in their German ops and automated market making. Became CEO in 2019.
Peter Spy publicly endorsed him, felt Galik was better suited as he got older. Seems like a smooth transition.
And Galik's overseen all this continued growth we've been talking about.
His long tenure suggests a deep understanding of the tech and operations. Seems aligned with the founding principles.
The board has some heavy hitters, too. Lawrence Harris, ex-SEC chief economist.
Brings that valuable regulatory perspective.
William Peter Fay, Thomas's son. Rich Repetto, respected industry analyst. Other independent directors, too.
A good mix of expertise, positive for governance.
Now, how about crisis response? The sources didn't give tons of specifics.
But they consistently emphasize robust risk management, strong capital, conservative balance sheet, automated controls.
Like automatically liquidating risky margin positions. Very tech-driven risk control.
Fundamental to their philosophy, really, comes from Peter High's market-making background, crucial for managing risk.
And they showed resilience during COVID, like shifting to virtual shareholder meetings quickly.
Seems operationally solid, but yeah, deeper crisis history might need more digging.
Communication transparency seems pretty high, though.
Yeah, quarterly annual reports, earnings calls, monthly metrics, investor relations.
Websites full of info, SEC filings, presentations, plus those portals, IBKR Campus, Traders Insight, for education and commentary.
They even give a daily mark-to-market on their own portfolio. That's quite transparent.
So overall assessment, honesty. Seems high, given transparency and ethics codes.
Capability, Peter Hafey's track record, Galik's experience, consistent profitability, looks capable.
Shareholder-oriented. Peter Hafey's huge stake helps align interests. Plus, recent dividend hikes, stock split. Seems positive.
And that 2019 leadership transition from Peter Fay to Galik looked like thoughtful succession planning, ensured continuity.
The only real flag, maybe, is Peter Lice's massive ownership concentration.
Right, 74.2%. Aligns interests, yes, but also means huge voting power, potentially less influence for minority shareholders.
It's a classic governance point with dominant founders. Alignment is good, but something investors need to be aware of.
Exactly.
All right, let's dive into Chapter 3, Financial Health. The numbers as of April 16, 2025. Market cap.
Around $66.7 billion based on that pre-market price dip and shares outstanding, though figures can vary slightly across sources.
That drop really shows how fast the market reprices on earnings news.
Even for strong companies. Okay, PE ratio, trailing 12 months, about 22.8.
Which is actually below their 10-year average. Interesting.
Forward PE, based on 2025 estimates, around 20.4. Again, slight variations possible.
A PE in the low 20s, below historical average, suggests maybe not overvalued, especially with growth expectations.
Potentially. Revenue growth. Pretty impressive lately.
Q1 2025 net revenue up 18.6% year over year. Full year 2024 was nearly 20%.
And analysts generally expect that growth to continue, maybe moderate slightly. Solid underlying business health there.
Profit margins. Gross margin is sky high, 94%.
Pre-tax margin, a good proxy for operating efficiency, also very strong. Q1 adjusted was 73%.
Net margin robust too, probably 67.5%. Though one source had a slightly lower figure, maybe accounting differences, but clearly highly profitable.
Those margins really scream cost advantages from their tech and scale. Huge competitive strength.
Debt to equity. End of 2024, about 98.9%. But you need caution with financials here, right?
Exactly. Client funds affect that. More important, they have more cash than debt. Operating cash flow covers debt easily.
And regulatory capital is key for brokers. They had over $11 billion in excess regulatory capital in Q1. Total equity, $17.5 billion.
That excess capital is a massive buffer. Shows real financial stability. Liquidity looks strong, too.
Free cash flow. This one's volatile year to year.
Yeah, big swings. Negative $16 billion one year, positive $16 billion another. Typical for brokers due to working capital fluctuations from client activity.
So trailing FCF isn't always the best measure here. Operating cash flow seems more stable and covers debt.
Right. Need to look at multiple metrics for the full picture.
Price to book. Around 4.02 by our math. Again, might vary slightly.
Notably higher than their historical average and some peers.
Suggest the market's pricing in future growth or valuing their assets at a premium.
Could be. reflects expectations for future profitability and returns.
Okay, so summing up financial health. Highly profitable, strong balance sheet, solid revenue growth, great margins, robust regulatory capital.
Earnings can be volatile due to market factors, that's acknowledged, but the overall picture looks quite healthy.
So bringing the first half together, IBKR has built this efficient global machine. Great scale, strong financials. That recent EPS miss caused a stir, but the core seems sound.
Agreed. Strong foundation.
All right, we're going to take a very quick break for a message from our sponsor, stockanalytics.ai. We'll be right back to talk market sentiment and more.
And we are back, diving deep into interactive brokers. Let's get into the second half, starting with Chapter 4, Market Sentiment. What was the mood around this stock on April 16th?
Well, as we established, the immediate feeling was definitely negative. That 9% pre-market drop says it all.
Investors clearly disappointed by that Q1 EPS number, even though it was only slightly below expectations.
Right. The market seemed laser-focused on that miss, despite the strong operational metrics, client growth, darts.
Even the positive news, like the dividend increase and the stock split announcement, didn't seem to move the needle much initially.
Didn't counteract that negative reaction. And
Yeah.
leading up to the earnings, the stock had some positive momentum, but was still off its 52-week high.
Plus, that whole backdrop of broader market uncertainty, tariffs, interest rates.
Yeah, that likely amplified the reaction. In a cautious market, any deviation gets magnified. What about the professional analysts? Before earnings, they seemed pretty bullish.
Generally, yeah. Average price targets were suggesting quite a bit of upside, mostly strong buy ratings.
But after the miss,
Quick adjustments.
Piper Sandler lowered their target, citing lower margin loan expectations. BofA trimmed theirs too, mentioning the economy and tariffs, though they kept a buy rating.
Shows how reactive analyst ratings can be to short-term news.
Definitely. The dominant story was the earnings miss, driving the stock down, overshadowing strong revenue and growth.
Positive news on dividend split got lost in the shuffle. And yeah, tariff talk added to the general market unease.
It's interesting that market reaction seems like potential myopia, right? Overreacting to a small EPS miss, maybe overlooking the bigger picture?
Could be. Sometimes creates opportunities for longer-term folk.
Potentially. Now, short interest and options activity.
Short interest was relatively low, about 2% of the float. Low days to cover, cheap borrow cost.
Suggests not a huge bet against the stock. Some off-exchange shorting, but no real squeeze risk indicated. Options market, though. That was buzzing before earnings.
Implied volatility was way up, high percentile rank. Options traders were clearly expecting a big move.
Higher than average volume, too. The market was braced for a reaction, implying like a 6.5% one-day move.
And they got it, just in the negative direction. Confirms the anticipation was there.
It really feels like the market fixated on that EPS number, maybe missing the underlying business strength. Underscores how sentiment can shift fast on earnings news.
Highlights why investors need to look beyond just the headlines, consider the full context.
Okay, let's move to Chapter 5, Ownership Structure. Who actually owns IBKR?
Institutional ownership is very high. End of Distec 2024, around 86.7%, held by over 700 institutions.
Suggests professional confidence, generally, but what were they doing?
Bit of a mixed bag in Q4 2024. Many increased holdings. Wellington, BofA, BlackRock were buyers.
But others sold down or got out completely. Egerton, Orbis.
BlackRock and Vanguard were still the top two holders. And more recently, Q1 25 Fifth Third Bancorp initiated a position, so differing views among the big players.
That divergence often reflects different strategies, risk views, valuation opinions.
Exactly. But the elephant in the room for ownership is insider holdings.
Thomas Peterfy controls 74.2% via IBG Holdings LLC. That's huge.
Exceptionally high concentration. There were some Form 4 filings early in 2025 detailing insider transactions.
But we'd need to look at those specific filings to know the details, purpose, size, price.
Right, but that 74.2% stake is the defining feature, shapes everything.
So Peterfy holds almost 3/4. The other 26% is institutions, most of the public float. The public, other insiders.
And those top 10 institutions hold a big chunk of that non-Peterfy piece.
So the actual free float might be smaller than it looks, could affect volatility.
Potentially. And governance-wise, Peterfy's control is paramount.
They have the formal structures, board committees, ethics codes.
But his stake means his vision and decisions likely carry the most weight. Limits minority shareholder influence, for better or worse.
Alignment of interests is strong due to his stake, which mitigates some conflict. Independent directors provide oversight, but founder influence is probably decisive.
It's that dual-edged sword again. Stability, long-term vision.
Versus Potential inflexibility, key person risk.
Exactly. Sometimes the market applies a founder discount for that reduced minority influence. And that divergence we saw in institutional buying-selling pre-earnings suggests differing views even before the latest news hit.
Makes sense. Okay, final content chapter, risk assessment. Let's do a quick SWOT. Strengths first.
Tech leadership, definitely. Significant cost advantages, extensive global reach and product offering.
Robust financials, experience-aligned management, scalable model. Pretty strong list.
Forms a powerful competitive moat, hard for others to replicate.
Weaknesses. Platform complexity for beginners can be one.
Sensitivity to interest rates, dependence on trading volumes.
Lower retail brand recognition compared to, say, Robinhood. Tiered interest rates on cash.
Yeah, those highlight areas for potential challenges or where competitors might push.
Opportunities. Continued international growth seems key.
Capturing more retail market share with IBKR Lite, expanding services, crypto, advisors, AI tools, ESG.
Leveraging tech further,
Right.
displacing higher-cost brokers. Lots of potential avenues.
Those could be significant growth drivers if executed well.
Threats. Intense competition, always.
Regulatory changes, scrutiny, PFOF, crypto, market structure, always a risk in finance.
Cybersecurity. Huge ongoing concern. Macro slowdown or recession hurting trading volumes.
Falling interest rates, hitting NII, geopolitical instability, trade disputes, like those potential tariffs.
Right, let's focus on that specific risk. Those hypothetical U.S. tariffs discussed early April 25. Imagine broad tariffs imposed then.
The consensus was that would likely mean reduced global growth, higher recession risk, maybe higher inflation or stagflation.
Increased market volatility, impacts on capital flows, interest rates possibly pressured upwards,
Yes.
sectoral impacts too.
Definitely a negative macro picture, generally.
And for IBKR specifically, weaker global economy means less trading activity hitting commissions,
Less appetite for margin borrowing and a slowdown, hitting NII.
disproportionate impact maybe since 83% of their clients are international.
Very possible. Currency volatility becomes a bigger factor, too. Translation risk, influencing client behavior. Plus, operational complexity navigating it all.
But could there be offsetting factors?
Maybe initial volatility might boost trading temporarily as people react.
And sophisticated clients might actually find IBKR more valuable for navigating that complex environment hedging, repositioning globally.
Flight to safety could increase demand for treasuries on their platform, too.
So overall assessment, tariffs look like a significant external threat. Likely pressure on both commissions and NII due to weaker confidence in economy, especially hitting their international base.
But it's paradoxical, right? Their platform's strengths could become more valuable in that messier world.
And the interplay with inflation and interest rates is complex. Tariffs might boost inflation, potentially raising rates, good for NII, but an economic slowdown could counter that by reducing borrowing and trading. Lots of moving parts.
Very dynamic situation.
Okay, let's bring it all home. Chapter 7. Brief conclusion and the end hook reveal. Synthesizing findings.
IBKR. High-quality business, durable moat, capable aligned management, strong financials. But earnings predictability challenged by external factors.
Market sentiment took a hit recently, but long-term potential seems intact. Risks are real, though, especially macro risks.
From a value investing angle, attractive business quality, management quality, financial strength, but valuation is key.
That post-earnings drop might present a more favorable entry point.
But requires rigorous individual analysis. Intrinsic value assessment, margin of safety, absolutely critical given the uncertainties.
And that leads to our final provocative thought tease. Maybe the market's short-term reaction created an opportunity for long-term investors who get IBKR's strengths and global potential, especially in this evolving world.
But, and it's a big but, further individual research is crucial. No shortcuts there.
Exactly. And the full end hook question is coming right up after a couple of quick messages.
First, if you found this deep dive helpful, please consider subscribing to the Stock Analytics AI YouTube channel for more financial analysis like this.
And now, the important disclaimer. This discussion is based on research as of April 16, 2025. It's for informational purposes only, definitely not financial or investment advice.
Any decisions you make should come from your own independent research, considering your personal situation and risk tolerance.
Also, remember, AI analysis has limitations. Our interpretations reflect the data available at that time.
Okay, and now for that final question we promised, something to really mull over.
Considering Interactive Broker's huge international presence, How might its long-term growth be shaped by both the increasing interconnectedness and the potential fragmentation of global financial markets?
And as an informed investor, what specific metrics should you be tracking closely to really assess how that dynamic is playing out for them?
So there you have it, our deep dive into Interactive Brokers. We really hope this gave you a solid, efficient understanding of the company.
Definitely check out the sources in the description for more detail if you want to go deeper.
And spend some time thinking about that final question.
Hmm.
Our goal was to get you well informed without drowning you in data.
We'd love your feedback, and any suggestions for future deep dive topics are always welcome.
And with that, we'll wrap up this exploration of Interactive Brokers. Thanks for joining us.
Until next time.